Welcome back to Old Men, New Money. I'm Douglas Borthwick, and today we're talking about why most people are scared of pure digital securities and what to do about it. Last episode, I introduced the insurer model, customers becoming owners through tokenized equity. It sounds great in theory, but when I pitch this to business owners and investors, I hear the same objections every time. Douglas, I don't want to manage a blockchain wallet. Douglas, what if I lose my private keys? Douglas, this sounds complicated. Can't I just get paper stock certificates like normal? And you know what? These concerns are completely valid. For most people, pure digital securities are intimidating. The learning curve is steep. The risk of user error is real. And this is why I developed the concept of hybrid security tokens. Give people both options, paper and digital, traditional and innovative. Let them choose. Here's your 30-second version. Hybrid security tokens offer investors both a traditional paper certificate or brokerage entity and a digital token representing the same security. Investors choose which form they prefer or use both simultaneously. This removes adoption friction by letting people transition to digital at their own pace, while still enabling those ready for innovation to access tokenized benefits immediately. It's the bridge between old and new. And let me be honest with you. When we were raising capital at INX, we were digital only. You had to have a digital wallet. You had to understand blockchain. You had to be comfortable with technology. And you know what happened? We lost potential investors who loved our business model, but were scared of the technology, of the packaging. Older investors especially. People who'd spent 40 years in traditional finance. They wanted in, but the digital-only requirements stopped them. I remember one conversation with a potential investor. He'd been a bond trader for 30 years, brilliant guy, understood fixed income better than anyone I knew. But he was 67 years old and had never used a digital wallet. Douglas, he said, I believe in what you're building. I want to invest $50,000, but I'm terrified I'll lose my private keys and lose everything. Can't you just send me a stock certificate? At the time, we couldn't. We were committed to pure digital, and looking back, offering hybrid options would have significantly expanded our investor base. Here are the real fears people have. Losing private keys and permanently losing access to assets. This is a valid concern with cryptocurrencies. Lose your keys, lose your coins forever. With security tokens, however, there's recovery through the transfer agent, but most people don't know that. Technology complexity intimidates people. Setting up wallets, securing seed phrases, understanding gas fees. For tech-savvy people, this is easy. For normal people, it's overwhelming. Regulatory uncertainty worries people. What if the SEC decides digital tokens aren't compliant? What if I need to prove ownership in court? Paper feels safer because it's familiar. Inheritance and estate planning get complicated. How do you pass digital assets to heirs? Traditional securities transfer through probate. Digital assets require specific planning. And these aren't unreasonable fears. They're real barriers to adoption. Hybrid security tokens addresses them directly. A hybrid security token represents the same underlying security in two forms simultaneously. Form 1 is traditional, a paper certificate or book entry position at a transfer agent or brokerage. This is the familiar format, physical or electronic, but definitely not blockchain-based. Form 2 is digital, a token on a blockchain that represents the same equity, same rights, same ownership, just in tokenized form. The critical point? These aren't two different securities. They're two representations or packaging of the same security. You don't own twice the equity. You have two ways to access and use your ownership. Think of it like having both a physical key and a digital key to your house. Same house, same access, two methods. You can use whichever is most convenient for your current situation. Now, let me walk you through the actual mechanics because this is where it gets interesting. When an investor purchases securities, they choose their preferred form. Traditional only, digital only, or both. If they choose both, they get a paper certificate and a blockchain token representing the same shares. The transfer agent maintains records of how each investor holds their securities. The cap table shows total shares and breaks down how many are held in each form. If an investor wants to convert from traditional to digital, they request conversion from the transfer agent. The transfer agent updates records, creates new tokens, and sends them to the investor's wallet. The paper certificate is cancelled or marked converted. If an investor wants to convert from digital to traditional, they initiate conversation through the platform. The tokens are burned or returned to the issuer's address. The transfer agent issues a new certificate or book entry. This entire process takes 1 to 5 business days. The beauty is investors can choose. If you're comfortable with digital, you get the benefits of tokenization, 24/7 access, instant verification for consumer benefits, programmable functionality. If you're not comfortable, you get traditional forms with familiar processes and no technology risk. Now, implementing hybrid security tokens requires running parallel infrastructure, which sounds expensive but is actually manageable. On the traditional side, you need a transfer agent who maintains a cap table, processes certificate requests, handles traditional transfers, manages dividends and distributions. And this is standard infrastructure that every company already has. On the digital side, you need smart contracts that represent the securities, custody solutions for digital token storage, wallet integration for consumer verification, compliance middleware to ensure transfers are legal. The integration layer connects these two worlds. The transfer agent system and the blockchain must stay synchronized. Every conversion updates both systems. Every transfer, regardless of form, gets recorded in both places. At INX, when we acquired Tokensoft's transfer agent, this integration was critical. We built systems that kept traditional and digital records perfectly aligned. Every night, reconciliation processes verified that total tokens plus total traditional certificates equal total outstanding shares. If there's ever a discrepancy, alarms go off. Human review happens immediately. This can't break. And let me give you step-by-step examples of how conversion actually works. Traditional to digital conversion starts when the investor logs onto the platform and requests digital conversion. They provide their wallet address where they want tokens sent. The transfer agent verifies ownership and checks for any transfer restrictions. The transfer agent marks the paper certificate as converted or cancels it entirely. Smart contracts mint new tokens and send them to the investor's wallet address. The cap table is updated to reflect fewer traditional shares, more digital tokens. The investor receives confirmation and can now use their tokens for consumer benefits. Timeline, 1 to 3 business days. Cost, typically $25 to $100 in processing fees, plus blockchain gas fees. Digital to traditional conversion works in reverse. The investor initiates conversion through the platform, specifying they want traditional form. They transfer tokens back to the issuer's address or a burn address. The smart contract registers the return of tokens. The transfer agent is notified of the conversion request. They verify the tokens were properly returned. The transfer agent issues a new paper certificate or book entry position. The cap table is updated. More traditional shares, fewer digital tokens. The investor receives their certificate or confirmation. Timeline, 3 to 5 business days. Cost, typically $50 to $150 because paper certificates have printing and mailing costs. And let me give you real examples of companies that have used hybrid approaches. Blockchain Capital Fund raised capital through a hybrid structure. Some limited partners held traditional fund interests. Some held tokenized versions. The tokenized version traded on exchanges with better liquidity. The traditional version went through typical private fund transfer processes. The interesting result? Over time, a significant portion of traditional holders converted to tokenized versions because they saw the liquidity benefits and realized the technology wasn't scary. Several real estate tokenization projects have also offered hybrid structures. Investors could own paper certificates representing fractional property ownership or tokenized versions. The tokens provided benefits like instant verification for renter discounts, which wasn't possible with paper certificates. Now, why go through the complexity of maintaining two systems? Because the benefits justify the costs. You reduce adoption friction dramatically. People who are nervous about pure digital can start with traditional forms and convert later. This expands your investor pool significantly. You enable gradual transition. Investors can move to digital at their own pace. Some never convert. Some convert immediately. Some convert over years. All fine. You provide emergency backup. If something goes wrong with digital infrastructure, investors can convert to traditional forms. This safety net increases confidence. You accommodate different use cases. For consumer benefits, digital is essential. For estate planning and inheritance, traditional forms might be simpler. Investors can optimize for their own specific needs. You create natural upgrade paths. As investors see others using tokenized versions successfully, fear of missing out motivates conversion. The network effects build over time. Hybrid security tokens also provide regulatory benefits that pure digital might not. Some jurisdictions are more comfortable with traditional securities. Offering hybrid options makes it easier to operate across multiple regulatory environments. If regulations change, you can shift emphasis between forms without fundamentally restructuring. Court systems understand traditional securities. If there's ever litigation, paper trails and familiar forms make things simpler. This reduces legal risk for both issuers and investors. Tax treatment is clearer for traditional forms. Auditors and tax professionals understand book entry positions and certificates. Digital tokens are newer and sometimes create confusion. Offering both removes tax planning complexity. Inheritance and estate transfer are well established for traditional forms. Lawyers know how to handle securities transfers through probate. Digital assets require specific estate planning, and not all attorneys understand this yet. Let me be real about what this costs because you need to budget it appropriately. Technology costs are higher than pure traditional, but less than you think. The smart contracts and blockchain integration might cost $50,000 to $150,000 to build. Integration with transfer agent systems adds $30,000 to $75,000. Ongoing platform hosting and maintenance runs $5,000 to $15,000 annually. Transfer agent costs increase slightly. They're maintaining two systems. Expect 10 to 20% higher annual fees compared to traditional only. Conversion processing fees, $25 to $150 per conversion, typically paid by investors, not the issuer. Legal and compliance costs are similar to pure digital. You're still offering securities. You still need securities lawyers, compliance systems, and regulatory filings. The hybrid nature doesn't add significant legal costs beyond initial structuring. Total implementation cost? $80,000 to $250,000 upfront. Ongoing annual costs? $15,000 to $30,000. For companies raising $1 million plus, these costs are manageable. They're 10 to 25% of the raise, which is typical for any capital raise. Now, based on what I've seen and what we learned at INX, here are mistakes to avoid. Don't make conversion too difficult. If the process takes weeks or costs hundreds of dollars, people won't convert. Keep it simple and affordable. 1 to 5 business days, under $150 total cost, including blockchain fees. Don't let systems fall out of sync. Your transfer agent and blockchain records must match. Implement nightly reconciliation. Build alerts for any discrepancies. Test your processes thoroughly. Don't forget about education. Investors need clear explanations of both forms, conversion processes, and benefits of each. Create simple documentation, video tutorials, FAQ pages, live support. Don't ignore the user experience. The conversion process should be one-click simple from the user's perspective. You handle the complexity on the back end. Make it feel magical for users. And don't neglect traditional investors. Just because you're excited about blockchain doesn't mean everyone is. Respect people's preferences. Support both forms equally. Don't make traditional holders feel like second-class citizens. And here's what I predict happens years 1 through 3. Most investors start with traditional forms. Only early adopters go straight to digital. Conversion rates are modest initially. This is the learning phase. Phase 2, years 3 through 5. As consumer benefits become clear, conversion rates accelerate. Digital becomes preferred by a growing percentage of holders. Network effects start building. Fear of missing out motivates holdouts. Phase 3, years 5 through 10, digital becomes increasingly common. A significant majority of investors may hold tokenized versions. Traditional forms become legacy options, still available but less frequently used. Eventually, hybrid might not be necessary, but for the next decade, it's the bridge that makes adoption possible. If you're implementing the consumer model, here's my advice. Start with hybrid from day one. Don't try pure digital unless your target audience is entirely tech-savvy. Offer both options and let investors choose. Make conversion dead simple. One click on the investor portal, clear instructions, fast processing, minimal fees, remove every barrier. Promote digital benefits aggressively. Show what tokenized ownership enables: consumer discounts, instant verification, potential secondary market trading. Create FOMO for digital advantages. Support both forms equally. Traditional holders shouldn't feel punished for their choice, and digital holders shouldn't feel like beta testers. Both are legitimate, valued investors. Plan for eventual evolution of traditional. In 10 years, you probably don't need hybrid anymore. Design your system so you can gracefully adapt as the market evolves. And what should you do right now? If you're implementing an consumer program, design hybrid offerings from the start. Budget for dual infrastructure. Find a transfer agent who can handle both traditional and digital forms. If you're an investor evaluating offerings, ask about hybrid options. If a company only offers pure digital, consider whether you're comfortable with that. If not, ask why they don't offer traditional forms as a fallback. If you're currently holding traditional securities, research whether your issuers offer tokenized versions. If so, learn the conversion process. Consider whether the benefits justify converting. If you have pure digital holdings, understand how to recover if you lose keys. Most security tokens have recovery processes through transfer agents. Document your holdings. Include digital asset information in your estate plans. Hybrid security tokens aren't the long-term future. Eventually, more people will be comfortable with pure digital, and hybrid infrastructure may become unnecessary overhead, but we're not there yet. For the next 5 to 10 years, hybrid approaches are the bridge that makes widespread adoption possible. The beauty of hybrid is that it removes the binary choice. You don't have to decide between old and new. You can have both. You can transition gradually. You can hedge your bets while still participating in innovation. And this is how transformations happen in the real world. Not through revolutionary replacement, but through evolutionary transition. Hybrid security tokens are that transition strategy. In our next episode, we're going to talk about where this really gets interesting. Brand loyalty meets shareholder value. When consumer-facing companies embrace the consumer model, something magical happens. Marketing departments and investor relations departments finally start working together. We're going to explore that convergence and what it means for business. I'm Douglas Borthwick. This is Old Men, New Money. If hybrid approaches make sense to you, share this episode with someone who's been nervous about pure digital. This might be the answer they need.